Welcome to the Finance Wisdom Summaries.
Common Stocks and Uncommon Profits. Chapter 1. Lessons from the Past. Historically, two main methods generated wealth: betting on business cycles, buying low, selling high, and finding truly outstanding companies and holding them long-term. The latter, holding outstanding companies, proved far more profitable and less risky even in earlier market eras. Significant wealth opportunities existed in the past by identifying and holding growth companies, without needing perfect market timing. Opportunities today are even better due to shifts in corporate management, focus on continuous improvement, not just family control, and the rise of corporate research and development. Modern economic policies, particularly government willingness to run deficits to combat unemployment, tend to make depressions shorter and are usually followed by inflation, which favors stocks over bonds for long-term investors. Bonds have become undesirable for average long-term individual investors due to inflation eroding purchasing power. Key takeaways from these chapters. Long-term holding of growth companies is key. The most significant fortunes are built by identifying companies with above-average growth potential and holding them for many years, riding out market fluctuations. Qualitative factors matter more than ever. Beyond financials, look for superior management, a commitment to research and development, and an ability to adapt and innovate. Inflation favors stocks. In an inflationary environment, holding common stocks of strong companies is generally superior to holding fixed income investments like bonds, as stock values can keep pace with or outpace inflation even if their initial dividend seems small. Notes for daily application. Imagine you're deciding between buying a new car with a predictable but modest fixed interest rate loan like a bond, or investing in a company that consistently invents revolutionary new personal transportation technologies. The car will depreciate, and the fixed loan won't protect you from rising costs of living. The innovative company, however, has the potential to keep growing and paying you more over time, outstripping inflation, even if its initial dividend seems small. This illustrates why growth stocks, despite short-term bumps, often outperform fixed income in the long run.
Chapter 2. What the scuttlebutt method can do. Direct, in-depth analysis of a company's internal operations, management, production, sales, research is ideal, but often impractical for the average investor due to lack of skill, time, or access to proprietary information. The scuttlebutt method, also referred to as OCL or the right way in the translation, involves gathering information about a company from its competitors, customers, suppliers, former employees, and university researchers. People tend to speak freely about their industry and competitors, especially when assured anonymity. Information from former employees should be cross-referenced and viewed with caution due to potential biases. The scuttlebutt method provides valuable insights that help an investor identify promising companies for further investigation before directly contacting the company's management. Understanding this method empowers investors to choose better advisors and evaluate their work. Key takeaways from this chapter. Information advantage through networks. Gaining an edge in investing comes from gathering information that isn't readily available in financial reports. Networking and speaking with people connected to a company's ecosystem can reveal its true strengths and weaknesses. Beyond the numbers. Financial statements tell only part of the story. The scuttlebutt method helps investors understand the qualitative aspects of a business that drive its long-term success. Independent verification. Don't rely on a single source of information. Corroborate insights from various perspectives to form a comprehensive and accurate view. Notes for daily application. Imagine you're thinking of investing in a local coffee shop chain. Instead of just looking at their annual reports, you decide to apply the scuttlebutt method. You visit a few competing coffee shops and casually ask staff what they think of your target company. You chat with customers coming out of their stores about their experiences. You might even talk to a former barista from that chain, being mindful of their potential biases. This informal information gathering can give you a far richer understanding of the company's strengths, weaknesses, and customer loyalty than any balance sheet alone.
Chapter 3. What to Buy. 15 Points to Look For in a Common Stock. Question 1. Does the company have products or services with sufficient market potential to significantly increase sales for several years? Look for companies with sustained growth prospects, not just one-time surges. Growth isn't always linear. It can come in spurts. Examples include companies lucky and able, like Alcoa, benefiting from industry trends, and lucky because they are able, like DuPont, creating new markets through R&D. Question 2. Is management determined to continue developing products or processes that will still further increase total sales potentials when the growth possibilities of currently attractive product lines have largely been exploited? This addresses management's forward-thinking approach beyond current offerings. Question 3. How effective are the company's research and development efforts in relation to its size? It's not just about spending, but about efficient and commercially wise R&D that leads to profitable new products. Coordination between research, production, and sales is crucial. Government-sponsored research can be valuable if it leads to commercial applications. Market research is also vital to avoid developing products for non-existent or too small markets. Question 4. Does the company have an above-average sales organization? Strong sales and distribution are as critical as production and research, though often overlooked by investors. Scuttlebutt is highly effective for assessing sales effectiveness. Question 5. Does the company have a worthwhile profit margin? Sales growth is only valuable if it translates into good profits. Analyze profit margins over several years, not just one. Avoid marginal companies with consistently low profit margins unless there's a fundamental positive change occurring. Question 6. What is the company doing to maintain or improve profit margins? In an era of rising costs, companies must actively pursue cost reduction through new equipment, efficient procedures, and smart management, rather than just raising prices. Question 7. Does the company have good labor and personnel relations? Good employee relations lead to higher productivity and lower turnover, directly impacting profitability. Absence of unions or long strike-free periods can be indicators. Fair compensation and a sense of employee value are crucial. Question 8. Does the company have good executive relations? A positive executive climate, where promotions are based on merit and suggestions are valued, is vital for long-term success. Question 9. Does the company have depth to its management? Beyond key individuals, a company needs a strong, deep bench of competent executives to ensure continuity and handle growth. Delegation of authority is essential for executive development. Question 10. How good are the company's cost analysis and accounting controls? Accurate and detailed cost accounting allows management to identify and address inefficiencies and price products correctly. Question 11. Are there other aspects of the business peculiar to the industry involved which may give the investor important clues as to how outstanding the company may be relative to its competition? This catch-all category includes factors like real estate acumen in retail, credit management, insurance costs, or patent strength. Patents offer protection, but continuous engineering leadership is more important for long-term competitive advantage. Question 12. Does the company have a short-range or long-range outlook in regard to profits? Companies that prioritize long-term relationships with suppliers and customers, even at the expense of immediate maximum profit, tend to be more successful over time. Question 13. In the foreseeable future, will the growth of the company require sufficient equity financing so that the increase in the number of shares outstanding will largely nullify the advantage of the anticipated growth? A company's financing strategy should support growth without excessively diluting existing shareholder value through new stock issuance. Question 14. Does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? Transparent management that communicates openly during both good and bad times is a strong positive indicator. Question 15. Does the company have a management of unquestionable integrity? This is the most crucial factor. Management must have a strong sense of fiduciary responsibility and ethical conduct toward shareholders, avoiding self-serving practices. Most important and impactful lessons. Holistic company evaluation. Don't just look at one or two financial metrics. A truly outstanding investment requires a deep dive into qualitative factors like management quality, innovation, and company culture. Management is paramount. The integrity, forward-looking nature, and depth of a company's management team are arguably the most critical aspects. They dictate the company's ability to navigate challenges and seize opportunities. Growth isn't enough. Growth must be profitable, sustainable, and managed efficiently. A company can grow sales rapidly, but fail as an investment if it lacks strong margins or good cost control. Key takeaways from this chapter. Imagine you're evaluating a potential career move. Instead of just looking at the salary and benefits, the financial metrics, you'd also research the company's culture. The leadership team, are they transparent and ethical? Their commitment to innovation and employee development. Do they invest in R&D and training? And their long-term vision. You might even talk to current and former employees to get the scuttlebutt. This thorough qualitative assessment mirrors Fisher's 15 points and helps you decide if this company is a truly outstanding place for your investment of time and effort. Imagine you're thinking of investing in a local coffee shop chain. Instead of just looking at their annual reports, you decide to apply the scuttlebutt method. You visit a few competing coffee shops and casually ask staff what they think of your target company. You chat with customers coming out of their stores about their experiences. You might even talk to a former barista from that chain, being mindful of their potential biases. This informal information gathering can give you a far richer understanding of the company's strengths, weaknesses, and customer loyalty than any balance sheet alone. Notes for daily application. Imagine you're evaluating a potential career move. Instead of just looking at the salary and benefits, you'd also research the company's culture, the leadership team. Are they transparent and ethical? Their commitment to innovation and employee development. Do they invest in R&D and training? And their long-term vision. You might even talk to current and former employees to get the scuttlebutt. And this thorough qualitative assessment mirrors Fisher's 15 points and helps you decide if this company is a truly outstanding place for your investment of time and effort.
Chapter 4. What to buy. Applying the principles to your own needs. The typical investor isn't an expert and dedicates limited time to investments. The popular image of a successful investor as a solitary, numbers-focused academic is largely inaccurate and dangerous. Statistical bargain hunting, while sometimes profitable, rarely yields the extraordinary returns of investing in magnificently managed growth companies. Growth stocks achieve superior returns because their value increases by hundreds of % over decades, far exceeding the limited upside of undervalued bargain stocks. Most investors lack the time, inclination, or geographic access to perform the necessary in-depth research themselves. For such investors, hiring a competent, honest, and philosophically aligned investment counselor is crucial. A counselor's past performance should be scrutinized over a period of at least 5 years, compared to market benchmarks and their investment philosophy understood. Growth stocks can be broadly categorized: large, established, institutional growth companies, type A, for example Dow Chemical, DuPont, or IBM, and smaller, newer, higher-risk growth companies, type C, for example Ampex in its early days, with a middle category, type B, for example PR Mallory, Beryllium Corp. Type A companies offer substantial long-term capital appreciation with less risk, often outperforming high-dividend stocks over time.
Type C companies offer the largest potential gains, but also carry the highest risk of total capital loss. Investors should tailor their portfolio mix, conservative versus aggressive growth, to their personal financial situation, risk tolerance, and goals. Only truly surplus funds, money not needed for emergencies or specific future obligations, should be invested in the stock market. Key takeaways from these chapters. Focus on true growth, not just bargains. Extraordinary wealth comes from identifying companies that can grow their earnings substantially over decades, not from simply finding undervalued stocks based on past performance. Know thyself and your limits. Be honest about your time, skill, and temperament for investment research. If you lack these, seek out a competent, ethical professional whose philosophy aligns with your own. Strategic allocation. Diversify your growth stock portfolio based on your financial needs and risk appetite, balancing stable, large-cap growth with potentially higher return, higher risk, smaller companies. Notes for daily application. Consider your financial planning for retirement. You could put all your savings into a low-yield savings account or fixed deposit, like a bond or bargain stock, guaranteeing a small, steady return. Or you could research a mix of well-established, globally expanding companies like Apple or Google, type A, and some promising smaller tech startups, like a new AI company, type C. Fisher suggests a balance. The stable giants grow reliably, while a small portion in the riskier, higher potential startups could provide explosive returns, provided you can afford the potential loss if they fail. This personal risk assessment and diversified allocation is key.
Chapter 5. When to buy. The core of successful investing is knowing what to buy, identifying outstanding growth companies. While timing is important, the conventional method of predicting short to medium-term economic or market trends is unreliable due to the current state of economic forecasting. Market prices react not just to overall economic conditions, but also to the internal development cycles of growth companies, such as costly R&D, pilot plant issues, initial sales expenses. Often the best buying opportunities arise when an outstanding company faces temporary, solvable problems, such as unexpected delays in new product launches, temporary labor disputes, or initial high expenses for market penetration. These moments of purchase occur when the market overreacts to short-term negative news, causing the stock price to decline despite strong underlying fundamentals and long-term prospects. For investors with an existing, well-chosen portfolio, new funds should be invested as soon as a good buying opportunity arises, ignoring general market timing. For new investors or those reallocating a static portfolio, it's prudent to invest funds gradually over several years, allowing for purchases during potential market declines. This strategy also serves as a practical test of one's investment ability. The current phase of the business cycle is only one of 5 influences on stock prices, including interest rate trends, government actions, inflation, and new inventions and techniques. Key takeaways from this chapter. Buy when fundamentals improve, not just when the market is down. The ideal time to buy is when a fundamentally strong company is experiencing temporary setbacks or when positive but unrecognized developments are about to bear fruit. Patience is a virtue, but not an excuse for inaction. Don't wait indefinitely for a perfect market bottom. If you've done your research and identified an outstanding company facing temporary issues or on the cusp of significant, unappreciated growth, act. Dollar cost averaging for new investors. If you're new to investing or have a large sum to deploy, staggering your purchases over time can mitigate the risk of buying at a market peak. Notes for daily application. Imagine you've identified a company that produces a groundbreaking new energy storage technology, and after thorough research, you're convinced it will revolutionize the industry.
However, the company just announced a delay in opening its first large-scale factory, and the stock price has dipped due to market disappointment. Fisher would say this is your moment of purchase. The underlying long-term potential of the company and its technology hasn't changed. Only a temporary operational hiccup has caused the market to undervalue it. This is when your careful qualitative research pays off.
Chapter 6. When to sell and when not to sell. There are only 3 valid reasons to sell a stock initially chosen based on Fisher's principles. Reason 1. A mistake was made in the original purchase. If it becomes clear that the company's factual prospects are less favorable than initially believed, sell immediately, regardless of a small profit or loss. Overcoming ego is crucial here. Reason 2. The company no longer qualifies under the 15 points. This can happen due to deterioration in management, for example, complacency or lack of ability in new executives, or the exhaustion of growth prospects for its products. When this occurs, sell promptly. Reason 3. A genuinely better investment opportunity has arisen. If a new opportunity promises significantly superior returns over a long period, even after accounting for capital gains taxes and the risks of a new investment, it might be worth switching. However, this is rare and requires extreme certainty. When not to sell? Due to general market decline fears, predicting market downturns is unreliable, and selling due companies based on such fears often leads to missing subsequent recoveries and incurring capital gains taxes. Because the stock appears overvalued. An outstanding growth company's stock may seem expensive relative to current earnings, but if its growth trajectory continues, its future earnings will justify or exceed the price. Selling too early due to perceived overvaluation means forfeiting substantial long-term gains. Because the stock has gone up a lot. This is a common fallacy. Successful companies continue to be successful. Selling a stock simply because it has performed well means abandoning a proven winner. The central principle: if the initial purchase was correct and the company remains outstanding, the time to sell is almost never. Key takeaways from this chapter: disciplined selling. Emotional biases like reluctance to realize a small loss should be avoided. Only sell when fundamental reasons dictate, such as a clear mistake in the original assessment or a fundamental deterioration in the company itself. Growth stocks are not tradable. Don't try to time the market or assume that a stock that has risen significantly has used up its potential. Outstanding companies can continue to grow for decades. Focus on the business, not the stock price. The stock price is a reflection of the business. If the business is thriving and its future prospects remain strong, temporary market fluctuations or high valuations should not trigger a sell decision. Notes for daily application. Imagine you own a highly productive fruit tree that consistently yields excellent fruit. You might consider selling it if you realize it's actually a weed, original mistake, or if it becomes diseased and stops bearing fruit, deterioration of company fundamentals. You might also consider selling it if you discover a new, more productive and resilient fruit tree with even greater long-term potential, a genuinely better investment opportunity. However, you wouldn't sell it simply because your neighbors think it's too big or because there's a rumor of a general fruit tree blight in the region. You'd hold on to your proven producer unless its fundamental health or potential truly changed. Chapter 7. The turbulence of dividends. There's significant confusion surrounding the meaning and importance of dividends. Companies might retain earnings instead of paying dividends to reinvest in new production, product lines, or cost-saving equipment, which can be more beneficial to shareholders than direct dividend payments. Retained earnings provide no benefit if management hoards cash unnecessarily or reinvests in inefficient operations. Inflation means that a portion of retained earnings is needed simply to replace depreciated assets at higher costs, not necessarily for growth. For the vast majority of shareholders, especially those in higher tax brackets, it is more financially advantageous for a company to reinvest earnings in profitable growth opportunities than to pay them out as taxable dividends. Dividends should not be the primary factor in selecting growth stocks. Companies with lower current dividend yields often provide greater long-term capital appreciation and eventually higher absolute dividend payouts. A high dividend yield does not equate to safety. Often, underperforming stocks have high yields. Companies should adopt a consistent dividend policy, e.g., retaining all earnings for growth or paying a fixed percentage, and communicate it clearly to investors, rather than changing it erratically. Main takeaways. Reinvestment for growth trumps dividends. For growth-oriented investors, a company's ability to profitably reinvest its earnings is far more valuable than immediate dividend payments, especially given tax implications. Dividends are a consequence, not a goal, for growth investors. Focus on the underlying business's ability to grow earnings, which will ultimately drive both capital appreciation and eventually larger dividend payouts. Consistency in policy. A stable and predictable dividend policy, even if it's no dividend, is preferable to erratic changes. Imagine you're a young professional saving for a significant future goal, like buying a house. You have two investment options: a company that pays out a large chunk of its profits as dividends, which you'd then have to pay taxes on and reinvest yourself, or a company that reinvests almost all of its profits back into research and expansion, leading to rapid growth in its stock value. Fisher argues that for most people, the second option is more beneficial, even if you don't see immediate cash payments. The turbulence of dividends refers to the misconception that high dividends are always good, when often intelligent reinvestment of those earnings by the company is more powerful for long-term wealth creation.
Chapter 8: 5 Don'ts for Investors. Don't buy promotional companies, new companies without a track record. While new companies can be exciting, they lack a proven operational history, production, sales, cost control, executive team, and are dominated by plans rather than facts. This makes them significantly riskier for the average investor. Promotional companies often have strong talent in one area, for example, invention or sales, but lack balanced management across all necessary functions. Leave investments in promotional companies to specialized groups, such as venture capitalists who can actively foster and compensate for weaknesses. Don't ignore a good buy because it's traded over the counter, OTC. The difference between listed and OTC stocks has become less about liquidity and more about market structure. The modern market, with fewer large speculators and more long-term institutional and small individual investors, has made liquidity generally lower across the board. OTC markets, particularly for well-known, actively traded OTC stocks handled by reputable dealers, often offer comparable liquidity to many smaller exchange-listed stocks. The key is to select a competent and conscientious dealer for OTC stocks. Don't buy a stock just because you like the annual report. Annual reports are marketing tools designed to create a favorable impression. Attractive photos and eloquent prose don't guarantee strong management or good fundamentals. Relying solely on an annual report is akin to buying a product based on advertising. It's impulsive and can be costly in investing. However, a poor or opaque annual report, for example, one that hides bad news, can be a red flag. Don't assume that a high price in relation to earnings per share means that the stock has discounted its growth fully. It's a common fallacy to believe that a stock trading at a high P/E ratio has already priced in all its future growth. If a company consistently generates new sources of growth, its high P/E is a reflection of its intrinsic quality and ability to continue growing, not necessarily overvaluation. Its P/E multiple should remain high or even increase. Selling a strong growth stock just because its P/E is high means missing out on significant future gains and incurring capital gains taxes. Don't confuse 1/8 with 1/4. Don't be penny-wise and pound foolish.
Don't let minor price differences, example, an extra eighth or quarter of a point, prevent you from acquiring a truly outstanding stock. The potential long-term gains from a quality investment far outweigh these small differences. For large purchases, strategically work with your broker to acquire shares without driving up the price excessively, accepting small price increases if necessary. Key takeaways from this chapter. Avoid speculation on early-stage companies. Unless you're a specialized professional investor, steer clear of companies that haven't proven their operational viability. Focus on substance, not superficialities. Don't be swayed by where a stock is traded or by glossy marketing materials. Dig deep into the underlying business fundamentals. Growth justifies valuation. A high P/E ratio for a truly exceptional growth company is often a sign of its inherent quality and future potential, not necessarily overvaluation. Don't let perceived expensiveness deter you from a great long-term opportunity. Don't trip over pennies to lose dollars. Never compromise on acquiring a high-quality stock for the sake of a marginal price difference. The long-term rewards of a good investment dwarf small entry costs. Notes for daily application. Imagine you're trying to buy tickets to a sold-out concert of your favorite band. There's a limited number of tickets left, and they're slightly above face value. Fisher would advise against haggling over a few extra dollars, the 1/8 or 1/4 difference, if you truly believe this is a once-in-a-lifetime experience. The joy and memory of attending the concert, the long-term gain, far outweigh the small additional cost. Similarly, don't let a minor price point prevent you from owning a piece of a truly outstanding company.
Chapter 9. Other 5 don'ts for investors. Don't over-diversify. While diversification is important, too much of it can lead to diworsification. Spreading your money across too many companies you don't adequately understand or can't properly monitor. The ideal number of holdings depends on the nature of the companies. For example, diversified conglomerates require less external diversification and the investor's ability to monitor them. Minimum diversification guidelines. Type A, large, solid growth companies, minimum of 5 stocks with no more than 20% of original capital in any one. Type B, middle ground growth companies, minimum of 10 stocks with 8 to 10% of original capital in each. Type C, small, high-risk, high-reward companies, maximum of 5% of original capital in any one, and only with funds whose loss can be afforded. These tend to either fail or grow into Type B status, at which point the increased value justifies the higher concentration. Quality over quantity. It's better to own a smaller number of truly outstanding companies you understand well than a large portfolio of mediocre ones. Don't be afraid to buy during a war scare. War scares or the outbreak of war often cause stock markets to fall, but this is a psychological phenomenon. Modern wars lead to increased government spending and inflation, which devalues money and generally causes stock prices expressed in inflated currency to rise in the long run. The time to buy is during the fear, gradually escalating purchases if war actually breaks out, focusing on companies whose products or services remain in demand or can adapt to wartime production. Don't forget Gilbert and Sullivan. Don't be swayed by irrelevant statistics. Don't place undue importance on historical stock price ranges or past earnings per share when evaluating a current investment. Past performance does not predict future value. A company's intrinsic value changes based on current and future conditions. Example, new management, new products, competitive landscape. Focus on fundamental business conditions and future prospects, not just historical data, which can be misleading. Don't fail to consider time and price when buying growth stocks. While avoiding penny pinching on price is important, it's also crucial to consider the timing of your purchase relative to significant, unappreciated developments within the company.
Sometimes buying based on a future date when a known positive development, example, factory completion, product launch, is expected can be more strategic than waiting for a specific lower price, especially if the company is already highly regarded and unlikely to drop significantly. This allows you to capture the full benefit of the impending development. Don't follow the crowd. The financial community often experiences fashions or psychological trends leading to mispricing of stocks based on sentiment rather than facts. Smart investors think independently and recognize when widespread financial opinions are based on outdated views, illusions, or temporary hype. The market is slow to recognize fundamental changes unless a well-known name or event is publicly associated with them. This creates opportunities for astute, independent thinkers to buy undervalued companies before the crowd catches on. Here's the key takeaways from these chapters. Optimal diversification, not maximal. Diversify enough to mitigate catastrophic risk, but not so much that you dilute your best ideas or can't properly monitor your holdings. Focus on quality over quantity. Emotional resilience during crisis. Don't let fear-driven market panics like war scares dictate your investment decisions. Understand the long-term economic impact of such events and act counter-cyclically. Future-oriented analysis. Past performance is a poor indicator of future results. Focus your research on a company's current internal strengths, future prospects, and management's ability to execute. Independent thinking is a competitive advantage. Resist the urge to conform to prevailing market sentiment. True opportunities often lie in recognizing when the crowd is wrong about a company's fundamental value or future prospects. And here's some notes for daily application. On over-diversification. Imagine you have a diverse group of friends, but you can only really nurture deep relationships with a few. Spreading your social energy too thin across too many acquaintances might mean none of your relationships are truly strong. Similarly, in investing, focus on truly understanding and monitoring a manageable number of high-quality companies rather than superficially owning dozens of mediocre ones. On not following the crowd. Imagine everyone in your social circle is suddenly obsessed with a new trendy diet. They're all talking about it, and it seems like the only way to be healthy. If you've researched it and found it lacks scientific basis or is fundamentally unsustainable for you, following the crowd would be detrimental. Instead, you stick to what you know works for your health. This independent thinking, based on solid research, is exactly what Fisher advocates in investing.
Chapter 10. How to find growth stocks. Finding outstanding growth stocks is time-consuming, requires skill, and is not a quick and easy process. The initial screening process is crucial. Identify which companies are even worth intensive investigation, as you cannot research all thousands of possibilities. Fisher's personal method for initial leads. About 1/5 of ideas came from friends in the industry, executives, scientists. About 4/5 of ideas came from a small number of respected, competent investment professionals across the country who specialize in identifying growth companies. These individuals, despite personal disagreements, had sharp financial minds and impressive track records. Public brokerage reports and general financial periodicals are generally not fertile ground for new breakthrough ideas. Consulting research labs, example Arthur D. Little, Stanford Research Institute, possess valuable technical and business development knowledge, but often cannot disclose confidential information. Once a promising company is identified, the next steps are critical before contacting management. Do not contact company management directly at this early stage. Do not spend hours analyzing old annual reports for minor balance sheet changes. Do not ask casual acquaintances for their opinion on the stock.
Do examine recent SEC filings, prospectuses, proxies for generic information on capitalization, financial position, sales breakdown by product line, competition, research activity, and unusual expenses. Do aggressively apply the scuttlebutt method. Contact key customers, suppliers, competitors, former employees, and related industry researchers. If insufficient scuttlebutt information can be gathered, abandon the investigation. Don't proceed with incomplete data. If some information is gathered but more is needed, consider asking your commercial bank for introductions to key individuals, as banks often have good relationships and can facilitate trust. Only after collecting at least 50% of the necessary information through the scuttlebutt method should you approach company management. This ensures you ask intelligent, informed questions and can verify existing impressions, preventing management from simply giving you a canned response. Management appreciates informed investors and will be more willing to share in-depth information if you demonstrate prior research and understanding. The reward for proper, in-depth investigation is substantial, a potential return of 4 to 15 times your original investment over 10 years, far exceeding what minimal effort could achieve. Key takeaways. Structured research process. Finding uncommon profits requires a systematic and rigorous research approach, starting with broad identification and narrowing down to deep dives. Prioritize scuttlebutt before direct contact. Gather external, unbiased information before speaking with company management. This empowers you to ask better questions and validate information. Effort justifies reward. Exceptional investment returns are not achieved effortlessly. They demand significant time, skill, judgment, and vision, just like success in any other complex field. Notes for daily application. Imagine you're trying to choose the best university program for your child. Instead of just looking at brochures or website rankings, the annual report equivalent, you first gather information from current students, alumni, professors from other universities, and even employers who hire graduates from that program, the scuttlebutt information. Only once you have a solid, well-rounded understanding of the program's strengths, weaknesses, and true value do you schedule a meeting with the department head, ready with informed questions that demonstrate your serious consideration. This thorough, multifaceted information gathering increases your chances of making an uncommon and highly rewarding decision.
Book's main idea. Common Stocks and Uncommon Profits by Philip Fisher champions a growth investing philosophy, urging investors to focus on identifying and holding shares of outstanding companies with superior management, innovative products, and significant long-term growth potential. Fisher emphasizes in-depth qualitative research, often dubbed scuttlebutt, over purely quantitative analysis or market timing. The core message is that true wealth is built by patiently investing in exceptional businesses that can consistently expand their earnings and competitive advantages over decades, rather than by chasing short-term market fluctuations or undervalued assets alone. This approach prioritizes understanding the business behind the stock. If you enjoyed the content, please consider supporting the author. Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.